Hey everybody, Casey Dimon here, TaxLienAcademy.com. Today we're comparing tax liens and tax deeds. Now we must first understand that every state is just a little bit different. So be sure to research the specific state that you're interested in for the most detailed information about that state. But let's go ahead and compare the two now. First off, what exactly is a tax lien? Well, a tax lien is a priority lien against real estate for failure to pay property taxes. These liens are issued by the county and then they're sold to investors known as tax lien investors. What happens here is an investor purchases these liens, typically in an auction setting, and they essentially pay the taxes on behalf of the owner to the county in exchange for the lien to that property and the interest rate that comes along with it. Now this interest rate can vary substantially depending on the state and depending on the competition at the tax lien auction. In the rare event that the owner fails to redeem this lien or fails to pay this lien, the lien does become foreclosable and the tax lien holder can potentially own the property. So then, what is a tax deed? Well, a tax deed is a term used to describe both the sale of and the deed to a piece of property that has been foreclosed due to failure to pay property taxes. In hybrid states, where both tax liens and tax deeds are offered, what happens is a tax lien is issued, it's purchased by a tax lien investor or held by the county, and then a tax deed is applied for after a certain amount of time. This tax deed is then auctioned off, with the opening bid set at the purchase price plus interest due to the tax lien holder, so the tax lien holder is reimbursed first if there are any bids. Now, in straight tax deed states, there is not an actual tax lien issued or sold, but instead the county themselves foreclose on the property and they sell the property at a tax sale. Now obviously there are a variety of different factors depending on the state, such as redemption rights and that kind of thing, but these are the basics between the two. So the primary thing that we need to understand is this. A tax lien is simply a lien on a piece of property that an investor earns interest on, and they also have the right to foreclose if that lien is not paid in full in time. Whereas a tax deed represents the transfer of ownership of a piece of property where the actual property is sold to an investor for failure of the former owner to pay the property taxes. Now I've created a variety of videos detailing both tax liens and tax deeds as well as redemption periods and all sorts of other stuff over at TaxLienAcademy.com. So head on over, check out those videos, browse through. There's a wealth of information on the website, and again the address is TaxLienAcademy.com. I really hope you've enjoyed this video, folks. Have a great day. Take care. Bye-bye.